Hi guys, welcome back to another video. Thank you guys so much for clicking on this video. If it's your first video, welcome to the Anderson's family. And if you're a returning subscriber, welcome back to another video. Thank you guys so much for all the persons who have been subscribing to our channel, liking the videos, and leaving a comment. Hopefully you guys find enough value that will keep you here, cause you to share some videos, and become a part of the Anderson's family. So if you have made a decision to migrate to Canada, one of the biggest goals that a lot of persons have is home ownership. In this video, I'm going to be giving you guys a step-by-step guide as to how you can own your own home in Canada as a newcomer. Now, it might take you a year, 2 years, 3 years, 4 years, 5 years. Regardless of how long it takes you, this guide is applicable. So if your goal is to own your own home, you're going to want to stick around and watch this video all the way through to the end. Now, before we get into it, you guys know the drill. Smash a like on this video if you haven't liked the video yet. Subscribe to the channel if you haven't subscribed already. And leave a comment. Let me know if you agree with these tips. If you are in a situation where you have purchased your home and you found these tips to be useful, or if you have other tips to share, leave it in the comment section so that other persons can benefit as well. Now, if you guys are new here, my name is Dems. I'm a Jamaican who migrated to Canada. Back in 2019, I came as an international student with my family, and we are now permanent residents of this beautiful country. We also own our own home, being here 5 years, but we own our home 4 years after being here. 2 of those years where I was an international student, and then another year where it was COVID. So you can see that there was a lot of things happening to delay us on that journey. But over the period of time, we have learned enough to share where you guys can also own your own home, right? So you're gonna want to watch this video all the way through to the end. Now, the first thing I would like to say is that the tips that I'm going to be sharing here, even though it's applicable all around Canada, the prices that I'm going to be quoting is going to be specific to Alberta, because just like any other country, you have cheap places and more expensive places. Canada is no different. Some provinces are more expensive than others, and you have to choose wisely based on affordability, but the process is typically the same. So it doesn't matter where in Canada you are, this can be relevant some way, shape, or form, right? So you've just landed in Canada. Your goal is to own your own home within a year. The first thing I always encourage newcomers to do is to start building their credit immediately. Now, the best way to start building your credit is to get a credit card. Many persons are from different parts of the world, the Caribbean, Africa, Europe, Asia, regardless of where you're from. A lot of these countries don't believe in the credit culture because, especially coming from Jamaica, having a credit card is not usually something that is encouraged. It's usually something that is dissuaded. Persons say, don't take a credit card, you're going to ruin this, that, the other. However, Canada is a credit society. Not having any credit is just as bad as having bad credit. So you want to start getting that credit building process as soon as possible. Now, your credit card is the easiest way to build credit. And once you have credit to say probably 3, 4 months, you are able to apply for a mortgage, providing other factors I'm going to speak about as well. And you are able to start establish yourself. Having 3 months of credit is usually what is required, right? Now, a credit card is usually fairly accessible for a newcomer. If you're an international student, you can walk into any bank, and most banks right now have a newcomer program specific for temporary workers, permanent residents, or even international students. So check with your local bank and see what credit card options are available for you. Start with a small balance. I always encourage newcomers to start with a small balance because the smaller the balance, the easier it is to manage that amount rather than getting overly excited with having a big balance and then you max your balance and not able to pay it off. Then you end up arming your credit rather than building your credit. If you guys are wondering if I'm qualified to speak about this, yes, I am. I've been in banking all my duration while I was in Canada. I've worked different roles, being a senior financial advisor, a manager of customer experience, a number of different roles. So I have done mortgages, I've done loans, I've done all of the relevant things. So these are factual information that you are actually getting that can be beneficial towards your own journey. So get yourself a credit card because that's gonna be very helpful in the long run, right? So you have now gotten your credit card. You start building your credit. The other thing you want to start doing is to start saving towards your down payment. Now, as a first-time home buyer, you are only expected to put down 5%, a minimum of 5%. Now, you can put down more if you want, but a minimum of 5% is what's really required as a first-time home buyer. Now, 5% of 100,000 is 5,000, right? 5% of 200,000 is 10,000, etc., etc., etc. It's the same math. 5% of whatever the value of the house is being sold for is what you are required to demonstrate that you have proof of in order to be qualified for the mortgage, right? Now, what I would like to say is that as a temporary resident, you are able to purchase a property. There's a lot of confusion around this, and that's just because I think it was last year, the year of 2023, the government of Canada made a temporary change to its policy preventing temporary residents from buying a home because, of course, with the housing crisis in Canada, newcomers were blamed for the shift in housing prices and all of those things. But it was quickly realized that that's not the real issue, and then newcomers or temporary residents can now purchase a home again. However, in order to be eligible to get a mortgage from a traditional lending institution, you're gonna have to have at least 6 months or more remaining on your permit. So if you have a study permit or if you have a work permit, you have to have at least 6 months or more remaining on that permit to get a mortgage from a traditional place. Now, it simply means that if your permit is being expired within the next 3 months, 4 months, whatever, you're not gonna be able to do it. But as long as you have 6 months or more, you're able to get a mortgage from a traditional lender. However, there is traditional lenders, which is the banks or mortgage broker usually help connect you with the best mortgage lender for your specific situation. But you also have third-party lenders. Now, the third-party lenders usually don't have as much strict requirements like the bank will have. However, there's a lot of stipulations that they would have that you won't necessarily find with a standard mortgage at a bank. So I always encourage person to take your mortgage from a actual bank rather than a third party. And that's just my own opinion, right? If you have a different opinion, please share it. Let's just talk about it. And the reason why I would say take your mortgage from a traditional place is because you have benefits like you can do like a early payout, you can do a prepayment, you can do like the extra. You have like a prepayment amount that can pay down your mortgage quicker and stuff like that. While some of the third parties you can't do that. And if you pay out early, you pay a penalty regardless. No more different factors. I'm trying to keep it very low level, right? So I know my different factors that they would have that the bank wouldn't necessarily have. So you want to look into that. So 6 months or more on your permit, and you're definitely eligible. Get your 5% up and running, and you are eligible. Now, there are ways that I would encourage you guys to save your down payment. And I want you guys to zoom in on my lips right now. Zoom. Hopefully they're not too dry. Are they too dry? Okay, I got the pre-approval. Zoom in on my lips right now, guys. Listen, do not save your down payment in a savings or a checking account. Right? This is the best tip I can give you. Do not save your down payment in a savings or a checking account. Instead, open what is called a first home buyer savings account or a registered retirement savings plan, and you start saving your down payment in that account. Now, the benefit of having those accounts are multifaceted. The first one I would say is it allows you to invest those savings. So if you have a long-term goal of say 5 years, you want to purchase your home, now you are able to invest every time you save on a monthly, weekly, bi-weekly basis. You're able to invest those funds into different vehicles. Like you can pop it in a GIC, which is a guaranteed investment certificate, or you can pop it in mutual funds, where the bank then take your money and pop it into the market, buy stocks, bonds, money market securities, different things, and then your money start growing, so little baby money, and then you have a little bit more than what you would have over 5 years. Now you're not able to invest in a savings account or a checking account. So I would encourage anybody to invest, put those money in a first home buyer savings account or a registered retirement savings account. And I'll tell you the other benefits of those accounts. Now, let's start with the RRSP. Now, your retirement savings plan is registered account that the government of Canada and CRA has given the Canadians and, well, residents of Canada the opportunity to save towards their retirement. Now, whatever amount of money you save within your registered retirement savings plan, your RRSP, it becomes a tax deduction. Now, a tax deduction is I'm not going to say it's a tax credit because tax credit is different than tax deduction, and I'm trying to keep it simple for you guys. Now, a tax deduction brings down your overall taxable income. So say, for example, you earn $60,000 in taxable income for the year, and you save $10,000 in your RRSP, you only pay tax on $50,000 because that $10,000 become non-taxable and it comes off your taxable income, and it becomes a tax deduction. So you end up paying less taxes for that amount that you save in your RRSP. Now, the difference is because you're saving for your retirement, there's only specific reasons you can withdraw that money non-taxable, right? So say, for example, you withdraw that money for a purpose other than retirement, the government is going to say, hey, we gave you this tax deduction. You didn't pay any tax on this $10,000. Now you want to take this $10,000 because you want to go shopping at the mall. We're going to tax it. So they're going to tax that $10,000. Then it's going to be added to this present year income. So you're going to end up paying tax on it as well. Now, apart from retirement, a big factor of the RRSP plan is what is called your first home buyer plan. Now, your first home buyer plan is when you can take that money from your RRSP, use it towards your first home, and you don't pay taxes on that money whatsoever. So you have the opportunity now to invest in your RRSP, get that tax deduction, and then get that money put down on your first house, non-taxable. Now, the thing with an RRSP is you have to pay back that money over a 15-year period of time. If it is that you don't pay back all that money, or you have a balance owing, or you didn't pay anything on it, all that's going to happen is after 15 years, the government is going to say you didn't pay it back, pay with taxes. Right? That's all that's going to happen with that amount. However, 15 years is a long time to pay it back, and then you still don't pay taxes on it, and you have it for your retirement. So I encourage everybody to do that RRSP. Now, your RRSP is usually have a maximum contribution limit. And the maximum contribution limit to your RRSP is 18% of your previous year's income. See, guys, when I'm done with you guys can just go and work in a bank right now. Your RRSP contribution amount is 18% of your last year's income, right? So you have a maximum contribution limit. Now, let's talk about the first home buyer savings account. The first home buyer savings account is really a fusion between the RRSP and what is called your tax-free savings account, which is a TFSA. Now, your tax-free savings account is an investment account that allows you to save, invest in the same vehicles, your GIC or your mutual funds. The only difference with the tax-free savings account is whatever interest you earn within that account is non-taxable, right? It's non-taxable. And then your RRSP, you get that tax deduction. Your TFSA, you don't get that tax deduction. Now, the first home buyer savings account is like a fusion between the tax-free savings account and the RRSP, which is your first home buyer savings account. Simply means that whatever interest you earn on your investment within that account, it's non-taxable. And whatever amount you contribute to your first home buyer savings account, you get the tax deduction, meaning that it comes off your total taxable income for the previous year. And here's a big part about the first home buyer savings account as well, guys. You don't have to pay back the money. So unlike your RRSP where you have to pay back it over 15 years, the first home buyer savings account, you don't have to pay it back. So you open this account specifically to purchase your first home. However, unlike the RRSP where you only can contribute 18% of your previous year's income, the contribution amount for your first home buyer savings account is the same straight across the board for everyone, and it's $8,000 per year accumulated, which means that it came in effect last year, 2023. So if you were in Canada, meaning that you would have been eligible last year, but you didn't open it, you'd have $8,000 for last year, plus $8,000 for 2024, which means that for 2024, the maximum you can contribute is $16,000. But you also have a lifetime contribution max for your first home buyer savings account, which is $40,000. Over the lifetime of the account, you can't contribute more than $40,000. And you guys may be wondering now, if I'm married, if I'm in a relationship, can me and my spouse both open a first home buyer savings account, both get the tax deduction, both get the tax, both get the benefits, meaning that we can both withdraw the money, purchase our first home, all of that? Yes, you can. Because the first home buyer savings account, it's specific, it's individualized, it's not on a family basis, which means that you both of you guys can do it. So you can put $8,000 in yours, they can put $8,000 in theirs. Accumulated, $40,000 maximum for you, $40,000 maximum for them. So together, we will have an $80,000 limit separate, and one can purchase the same property. Hopefully that makes sense. I know that was a mouthful, but I want you guys to understand that these accounts are there for this reason. So if you're new, the first thing you're going to want to do is to take out a credit card so you can start building your credit. Then open a RRSP, open a first home buyer savings account so you can start saving your down payment. And the reason why I suggest opening both in comparison to opening one is because you don't know what the value of the house is going to be. And both of these accounts have a contribution limit, which so as you max out the contribution limit on one, you still have the other one. You can put the money there as well. Set up what is called a pre-authorized contribution or a PAC. A pre-authorized contribution is a set amount that goes to these accounts every time you get paid. Most banks have a system where they take it out your account without you knowing on your payday and a designated day that you choose. It can be as small as $25 a month. That's the minimum you need to invest in mutual funds in most banks. $25 a month. So your $25, the bank take your $25, put it with this millions of dollars of pool funds and pop it in mutual funds, right? So you keep investing at $25 and it keeps growing. A minimum of $25, right? So that's like a burger these days. That's like that's a box of pizza right now. So these are things that you can do as newcomers that makes it very easy for you to both get tax deduction, start investing, and get a huge benefit when it's time for you to start to ready to buy your house, right? So set up a pre-authorized contribution to have that money go there without you looking, without you even knowing where it's going, right? I highly encourage every single newcomer watching this video right now and have goals of buying their house within a year, 2 years, 3 years, 4 years, 5 years of Canada. In Canada, don't just look on the big picture of owning a home, but look on the small picture of what it's going to take to get you there to own a home as well. So you do these things to make sure that you are paying less taxes. It's a big thing. Not only that you are paying more taxes, but you are putting yourself in a position to purchase a home whenever you are ready. So apart from your down payment, apart from your credit, the other thing that you're going to need to demonstrate to purchase your first home is income. Your income is going to have to demonstrate that you can pay your mortgage. And most times, a basic income can get you a mortgage, right? Now, I'm not saying that if you have a basic income, you can go and get $1 million house. That's not what I'm saying. But I'm saying as long as you're reasonable and you're looking for a house in a reasonable affordability price line, and you are earning like $2,500, $3,000 a month, usually you can get a mortgage, right? Providing what is called your debt service ratio, your DSR. Now, your debt service ratio is really what you earn compared to what you owe, right? Now, you want to make sure that you keep that underneath 40%, which means that your total overall income, if it's $100,000 per year, you don't have monthly bill loan payment exceeding $40,000, right? So 40% or less is an acceptable debt service ratio. You don't want to be like basically on par. It shows that you don't have what's the banking term? What's the banking term for this again? You don't have what's the term I'm looking for? I can't remember. I'm not in banking anymore. I'm so excited. That term, you don't have the capacity. That's the word I'm looking for. You don't have the capacity to manage the mortgage, right? As long as you demonstrate that you're underneath 40% of your debt service ratio, usually you can get a mortgage, right? Now, if you have good credit but you don't have the income, somebody have the income but they don't have good credit, you guys can combine. So you can buy a house jointly. You can buy a house jointly with your spouse, with your family member, even with a friend. It doesn't matter who. There's no requirement for you guys to be a certain relationship. in order to buy a house together. However, what I would say is that a house is a long-term investment, is a long-term asset. So if you're partnering with someone, make sure that everything is in black and white. It doesn't matter the relationship right now, relationship change in the future. Make sure that everything is in black and white. Don't just say, no, them they tell me this. No, this, that. No, make sure that everything is in black and white. If anything happens to me, this portion of the house goes to my child. This portion goes there. Whatever. I've seen it all, guys. I've seen it. Don't forget, if you're buying a house with someone, apart from your non-verbal agreement, not what I say, non-verbal, apart from your verbal agreement, make sure that everything is in black and white. So even if you and the person is not even talking to each other in the future, you guys know exactly what is happening right here, so right now, because it's in black and white. Now, that's how you go about purchasing your first house as a newcomer. The other thing you want to do is to make sure that you are familiar with the housing market within your local community. Make sure that you're keeping up to date with like the cost of houses, the type better houses to buy, when is it better to buy, when is it not better to sell, the mortgage rates, the Bank of Canada rate, interest rates, all of these things are factors that's going to be beneficial to you when it's time for you to buy your house. So you want to be keeping a close eye on all of those things, right? I strongly encourage persons that if it is that you have a goal of buying a house, start having the conversation even if you don't have the down payment yet. It's better to start having a conversation and put yourself in the position to have a house within another year, within another 2 years, whatever the case may be, but it starts now. A lot of times what we do is we always put it off for another time. Oh, I want to buy a house in another 2 years, but what are you doing towards it? Have you opened a first home buyer savings account yet? Have you start speaking to your bank about a credit card yet? Are you managing your credit card properly? I have done a video where I spoke to you guys or shared with you guys how you can manage your credit card effectively to increase your credit. But for the purposes of the new persons watching this video, I'll share a little bit of tip again. Now, for your credit card, you want to keep your credit card within 75% of your limit to maximize your credit building opportunity. Now, when you have a credit card and you only pay your minimum payment, it's not affecting your credit. Your credit is not negatively being affected, but you're not increasing your credit. You're not increasing your credit because it shows that you're just making your payment, but you still have a balance, a big balance, more than 75%. So when you have a big balance on your credit card, it affects your credit. It affects your credit because it knocks down your capacity, right? So the one thing you want to do is to keep a close eye on two dates: your statement date and your payment date. Now, your statement date is when your statement is generated. Your statement is generated for whatever balance there is at that present day. And your payment date is the deadline that you have to make that payment. So this is a trick. This is a trick. And the banks will not tell you this. They will not tell you this, but this is a trick. Now, I'm not in banking anymore, and if I should be working in a bank again, my future employer, I apologize in advance. Now, this is a trick. Now, if your statement date is the 9th of every month, it means that your statement is generated overnight. The 8th, midnight, your statement generated, right? So then on that date, your statement is generated and I get a credit card statement that shows you to pay this amount by, say, the 30th of the month, for example. What you want to do now is at least by the 8th of the month to put that balance more than 75% of your credit limit. So if you have a $1,000 credit limit, make sure that you pay off at least $750. Statement is generated on the 9th, which shows that you only have a balance of 250? 250 dollars. Yeah, my math is not mathing right now. $250. So your balance is gonna be $250, and you're gonna have a minimum payment of say about $10. Now here's the trick. On the 10th, you can just max out back your credit card. So it simply means if you have your light bill to pay, if you have your grocery bill, if you have all of those things that you can use a credit card to pay, and you usually would use your debit card to make these payments and whatever date, put all of those funds to your credit card. And then on the 10th of the month, you use your credit card to pay off those bills. And then you do the same cycle, which means that you still have the $10 payment by the 30th of the month. And then the 8th of the other month, you do the same thing. So essentially, all you're doing is recycling the same money. You're just recycling the same money. And then that shows that you are managing your credit card effectively. You don't always have a limit over 75%, and you are golden. And you do that for 3 to 6 months, and your credit will leave from 600 to probably 800. I promise you guys this, right? So you want to do that in order to start building your credit. The other thing that I personally struggled with when I just got here was making my bill payment on time. Coming from Jamaica, what we usually do is we juggle money a lot. We put off the light bill to pay the water bill because it's not affecting the credit. The worst I have to worry about is JPS coming in your yard or water commission, and if they come, you beg it out. That is the society that we're coming from. However, here in Canada, you want to be paying your bills on time. Because if you don't pay your bills on time, it can affect your credit because it goes on your credit after you miss a couple of days, or not a couple of days, but like a while. I'm not sure the specific time, but it goes on your credit after a while. So you want to make sure that you're making those payments as quickly as possible and in full. The other tip I would like to say to all of you lovely people is, again, coming from Jamaica, when you have a credit card balance, you just pay a minimum payment. And if the bank call and say, hey, this is going to be written off in bad debt, you'll be like, bad debt, I don't have to worry about this anymore. Absolutely. Let me tell you guys this. In Canada, do not, no matter what the case may be, do not allow any accounts to be written off. If you allow an account to be written off, it can affect you upwards of probably even 10 years. Do not allow any account to be written off. If you struggle to pay it, continue struggling to pay it. Don't allow your accounts to be written off because it's going to have a negative impact on you for like the duration of your tenure in Canada. Also, when you hear a person say that we're going to send this to collections, now, what I would like to say is try as best as possible to work out an agreement with your debtors so that don't go to collections. Now, when it go to collections, it's not written off, so it's not as bad as written off. So collections don't quite impact you the same way as how a written off account affect you. Don't allow an account to go get right off. But if you can avoid it going to collections, you avoid it as well. However, if you go to collections, you make sure that you work out a deal as soon as possible. You make that payment, you close out that account, and then you get a couple months and then you call and say, oh, listen, remove this off my credit because it's paid off. And then your credit will start building back. So don't allow an account to be go to collections. That's the first step. If it goes to collections, never allow that account to be written off. A lot of newcomers, a lot of immigrants don't understand the implications of having a written off account and the significance. Having bad credit, can determine the type of job you get. First thing first, you can't work in a bank if you have bad credit. The second thing is it affects where you live. A lot of places, a lot of rental companies, they pull credit check, and if you have bad credit, you can't get into the apartment or whatever. So having bad credit determines the type of car you drive, the type of phone you have, every single thing. Having bad credit affects like your entire life here in Canada. So you want to make sure that you're keeping up to terms with all of those lovely things, right? Anyways, that's all I would like to share in this video. And to let you guys know that it is possible to buy a house within a year after landing in Canada. I know quite a few persons who have done it. It is very possible. You just have to have the right plan and the right guidelines to follow, and then you will be able to become a homeowner in Canada as well, depending on the affordability as well. I know that in other parts, houses are very expensive, but some other parts, houses are very affordable. So have a clear plan. If this is your goal, take the baby steps to get there. That's what I would say to you guys. If you haven't already subscribed, please take a second and hit that subscribe button. Smash a like on this video. Let me know if it was helpful for you. And leave a comment. Let me know if you agree. If you disagree, if you have another tip to share with the audience, I'd really appreciate it. All right, guys. Until next time. See you guys in the other video. Peace.